Good evening, everyone. This is Steve Nelson. I'm president of the Nebraska Farm Bureau, and welcome to this important webinar. I'm sure that you will find it very informational and very helpful as we learn about and learn to understand all of the changes related to the tax legislation that has passed recently. Again, thank you very much for joining. I know that we have quite a large number of people on and people coming in all the time here. So, but I just wanted to say, certainly on behalf of myself and the board of directors of Nebraska Farm Bureau, appreciate you being on and certainly hope and know that you will be helpful. We have really great folks lined up, particularly Tina Barrett from the Nebraska Farm Business Incorporated, and the foremost expert really in Nebraska on agricultural taxes, and so really looking forward to that. Jay Rempe is also on, and so I think will be a very, very good amount of time spent here. So I believe at this point, I'll just turn it back over to Jay Ferris. He'll talk about the system that we're on and the ground rules, and then we'll just move on with the program. So again, thank you, and have a great evening.
Yeah, thank you very much, Steve. Again, this is Jay Ferris with Nebraska Farm Bureau, and I will be kind of monitoring the webinar this evening. So just a couple of quick things. Tina is going to give a presentation, and while she is presenting, if there's questions that come up that you might have, there are two ways for you to ask those questions. One is there is a little icon that looks like a hand. If you click on that, I'll see that your hand is raised, and I can turn your microphone on, unmute your microphone so you can ask that question. If you don't want to be speaking live in front of everybody, you can also, there's a chat or a question box, and you can ask your question in either one of those places, and I can interrupt Tina during that if it's an appropriate question where we're at, ask her that question, and then at the end there, I believe there will be time for questions and answers as well. So those are the main rules. Feel free to chat or text any questions you might have to us, whether it's related or if you're just having some issues getting logged in or something, please feel free to let us know that as well too. So with that, Tina, I'm going to turn it over to you.
All right, well, thank you. I'm going to start off by saying that there's a lot of information in this Tax Act that we're still going to be waiting on rules and interpretations from IRS on, but we're going to go through what we think we know, because it's probably important to remember that Congress writes these rules, and then it's IRS's job to interpret those rules and give us really the rules that we have to follow in preparing returns. So even though we have this really long document of tax law, we're going to be waiting anywhere from probably 3 to 9 months for some of the regulations to come out from IRS. Those will likely come out as proposed regs, which will give people time to comment on that, and then we'll get final regs, which even could come a year or two down the road. So it's not that always this is an easy process in getting these, especially these kinds of major changes, really set in stone and figuring out how it's going to affect everyone. But I wanted to start, let me see if I can get going here. I wanted to start with a couple things that really seem to be the most misunderstood, and the things that we keep getting the most phone calls on. The first one was, we got a lot more phone calls in December on, was whether or not you should prepay real estate taxes, because everyone was concerned that their real estate taxes are going to get limited to $10,000 a year. So it's important first that we step back and say, okay, there's two different types of real estate tax deductions that we can get. One is our farm real estate taxes that you might deduct on Schedule F, or on your corporate return, or on your Schedule E if you're renting it out. And then there's the personal real estate taxes on our houses that we deduct on Schedule A. And those are the ones that are being limited to $10,000 a year. We'll talk a little bit more about that as we get into that, but it's a combined tax between income taxes and real estate taxes, but it's personal on Schedule A, nothing else was affected. The other one that has caused some concerns was the elimination of the interest deduction. Again, most of that discussion leading up to this tax bill was discussing about the elimination of real interest on mortgages on that Schedule A as well. They did put some limit on that, but the other place it was limited was if you gross more than $25 million. If that's the case, then we've got some special rules. You're still not completely out of it. We just have to follow some different rules in order to qualify. So for the most part, real estate taxes and interest as far as your farming business goes are still safe, still completely deductible. Okay, if that $25 million is an issue for you, which we're probably talking about some cattle feeders as being the operations that it could affect, they have capped it at 30% of your adjusted taxable income. And again, there's so much complication in this because the determination of what adjusted taxable income is changes in 2022. So what we are going to have for a few years is going to be different. But mostly if you're going to have 100,000 of income, you can still deduct 30,000 of interest, no problems. And if you're a farmer, we can still do 100% of interest. We just have to use an ADS life, which is just a longer life class. So to give you an idea, most tractors under a GDS life would be a 7-year property. And if we use the ADS life, it'd be a 10-year property. So a little bit longer depreciation, and you can't use bonus depreciation. So again, it's not going to affect a lot of Nebraska's farms, but if it does, make sure you talk with your tax preparer and making sure that you can continue to get that interest deduction. One of the big things in there was the estate tax exemption was doubled. So this applies to deaths after 2017 and before 2026. That basically means you have to die in 2018 to 2025. So what it did is it moved the per person exclusion for 2018 up to 11.2 million. Yeah, and it's going to index for inflation each year, so that's a great deal. Problem is we still don't know when we're going to die, and so it still makes planning very hard. I guess I skipped that a little bit, but what happens in 2026 is it goes back to the index value for 5 million. So like right now, we'd probably still be talking somewhere in that $6 to $7 million range, depending on what inflation does in that time period. So that one's still going to be going up, but it will basically be cut in half. So this is kind of nice. It may put off your need to do any significant planning until that 2024, 2025 range. But until we get permanent law, this is still, it's just nice, but it's not great. The other thing, to think about is there's other reasons to do estate planning, and whether it's making sure that the assets are left the way that you want, that the next generation can continue to operate in an organized manner. All those kinds of things might still make it a reason why you want to think about that estate planning, even if you're maybe not in the realm where you're going to be looking at paying estate taxes. Okay. Let's move on a little bit to what happened to C corporations. So the C corporations got a flat tax of 21%, and I have listed there the old rates. And actually, as I was pulling through some of this information, I didn't even know those bottom 3 existed. And when I started looking, I'm like, well, taxable income of 10 million doesn't come up in my office very often. So that would be why we missed that. But there were some pretty crazy brackets, and it went up and down and all over the place. And now those are all gone, and it's 21% from $1 until whatever dollar it is. So for most corporations, this was a tax cut. For most of our farm corporations, this is probably a tax increase. And probably the only group of producers that I work with that will actually pay more tax as a result of this bill. And that's only because we typically kept our C corporations at 50,000 of taxable income. So we were taking advantage of that 15% bracket, not recognizing much more than that. So that means for those operations that were recognizing that 50,000, they are probably looking at paying an extra $3,000 in tax, which is just 7% of 50,000. So not terrible, but a little bit of an increase. They did eliminate the alternative minimum tax for corporations. Just goes a little bit to simplifying things. Probably again, with those income levels, not a huge issue until it comes time to liquidate, but it's nice that that's gone and no longer part of the law. One thing that's nice about this is it's permanent, which means there's no sunset. So a lot of these other rules that we'll talk about are like the estate tax, where it goes away in 2026. but this is permanent, and this one was going to stay. So, and again, anytime we say permanent with tax law, that only means until Congress changes it again, because they could go in and change it, but there's nothing that's going to automatically take it away. For you that have fiscal year corporations, there's kind of a unique little issue going on here. Normally, we would take, they would say this is for tax years starting after 12/31/17, but they said these rates start January 1st of 2018. So that means if you have a fiscal year corp that ended in November, next year when you file your tax return, you're going to have 1 month that's going to be taxed at the old rates and 11 months that's going to be taxed at the new rates. So it's going to make for some interesting calculations as we get into these fiscal year corporations that start to have some 2018 months in there. So just something to watch, and something that I will be very glad my tax software can handle. I think the biggest benefit for these C corporations, and something that's probably a little hard to keep in mind as you think about having to pay a higher tax, is that this is going to make a big difference when it comes time to end that C corporation. And we've talked a lot about especially some of those old corporations that, from the 1970s that are full of land that have appreciated in value, and we have some very significant tax liabilities to getting that out of there. This is probably just about cut that in half, and so that's pretty significant. So if you're in a position where you might have been thinking about getting out of that C corporation or switching it to an S, this is going to be a great time to do that. And again, it's permanent, but until they change it is really what that means. So we don't know exactly how long we'll have 21%. It probably will depend on if it really does stimulate the economy the way that everyone is hoping. But just let me go through a quick little idea on the switching to an S, because that's really the best way to get that land out. And in the past, we've had to sit through a 5-year holding period where any income that was recognized essentially would be taxed at the highest federal rate, which was that 39%. It still says highest federal rate, which means it's 21%. So that means that switching to an S corp is not going to be as painful as it was in the past. And the same way with liquidation. If it's time to liquidate, we can get that liquidated at that 21% instead of maybe like an average of like 35. We still have the double taxation on the personal side, but again, so I'm not saying this is something that everybody should jump ship out of their C corps. It's just a matter of if you were already looking at that or thinking that that might be a move that you want to make, now would probably be a good time to get that going. Okay. All right, I'm going to switch gears again here. We're going to talk about the other major thing that everybody keeps talking about. The domestic production activities deduction was eliminated, and that's maybe something you know about, maybe not. It has been around for quite a while now, and it's allowed us to take a 9% deduction for any business that was producing a good or service in the United States, and so that obviously covered farmers. We had a limit on that it had to be 9% or 50% of wages, whichever is less. So that took some operations out of that. You might have heard more about this from your co-op, because co-ops were allowed in this law to take that deduction for themselves or pass it through to their patrons. And so, there was a lot of co-ops in the last few years that have been giving you, you get a letter, usually in December, saying this is your share of the deduction that's going to come, and we've been able to claim that. Well, that's going to be all gone, and so that goes a long ways to simplifying things. But then what they replaced it with, or not really replaced it with, but kind of threw in there, is this 199A, and so we'll talk a little bit about that. It's not very often that we talk about code section, and that's the common way we refer to things. We do it with section 179. And a few of those kinds of things, but I think section 199A is going to be what we're going to call this. And if there was one way that they messed up simplifying the tax law, this was it. This is far from simplification, and this is what's going to take quite a while to sort through from IRS's standpoint. But I put the co-op out letter on there because as I've met with producers to get the year closed out and things, one of the things I've been hearing the most is I've got this letter from my co-op, And we'll talk about that a little bit. But that letter is a lot of times telling you that you should sell your grain to the co-op because they can get you this better deduction. But let's go through the deduction from the start and then talk about how it affects the co-op. So this section 199A goes to non-corporate taxpayers. And so it gets a little confusing, the fact that we're not talking about S Corps. So this is basically any business that's not a C Corp. So partners in a partnership, S Corp shareholders, sole proprietors, which means if you're filing a Schedule C or a Schedule F, Schedule C would be those non-farm businesses, Schedule F being any farm business. And really this all got drafted as a way to make it fair for the 21% flat tax that the C Corps were getting. Okay, so that's why C Corps are out of this, and it's just that trade-off. Okay, so what we get with Section 199A is 20% of qualified business income is allowed as a deduction. Okay, so we're going to have to go through some definitions, and this is what we need IRS's help with, is what exactly is qualified business income, but we'll go through what we think it is. This deduction does come after AGI, which is adjusted gross income, or if you look at the bottom of the first page of your 1040, that's adjusted gross income. This is going to come after that. So that creates some issues in and of itself. For us in Nebraska, we use federal AGI as a starting point for the deduction. So that means that we are not going to be able to use this deduction for our state income tax returns. The old domestic production activities deduction was before AGI, so it did count towards the state. So we've got some things going there. It also means that it doesn't reduce self-employment taxes. Okay, so this is only against income taxes. I've got in here that it's a lot of calculations and limitations, and if you read this, it would just about make you go crazy, because it's awful hard to follow and track through all the different ways to calculate this. There are limitations over $315,000 of income, so if your income's above that, you will also have to have a wage limitation or a calculation of your investment in property. Okay, I'm not going to spend a lot of time on that. If that affects you, you know, then we can work with your tax preparer and figure that out, because we're not exactly positive on how we're going to calculate the investment in property either. So lots of things moving forward here. Couple other things with this deduction being after AGI, things that we need to watch is it's not going to affect your income for health insurance credits. So if you're getting your health insurance on the exchange, we could potentially be seeing a higher income because that DPAD is gone, and this is coming after that. It's going to affect your federal financial aid calculations if you've got kids in college. It's going to affect some of your credit calculations. So maybe your child tax credit could be affected if your income is high enough. Lots of things going on there. The other thing that we have to kind of really caution with this, like I told you, there's been some technical corrections that are promised to come with this, which means that Congress is going to rewrite some of the rules before IRS even gets a chance to interpret them. But either way, until IRS gets to fully interpreting this, we're not going to know exactly how this works. So everything I've got here is kind of some best guesses, but it's all subject to change. So make sure you remember that. Okay, so qualified business income is net business income from the taxpayer's non-Schedule C business. Okay, so that's kind of a fancy way of saying it's your Schedule F, it's what's coming through from your S Corp. We're pretty sure those are straightforward, no problems. We also know that it's not any short-term or long-term capital gains. It's not dividend or interest income. It's not guaranteed payments that you receive from a partnership, which is interesting because those are subject to self-employment taxes, but it specifically says we don't have those. It's not wages that you receive as an employee. So if you're receiving wages from your S Corp, we can't count that as income for this qualification, or any non-business income. So, you know, any Social Security income, any retirement distributions, any rental income, kind of. Okay, so we're going to talk about that too. So how is this going to affect rental income? Again, this is going to be one that's going to be very interesting to see how IRS does this one, because we think the way that the law was written, that it's going to take a rise to a level of a trade or business to qualify your rental income. So that's kind of a definition that we use, that we talk about when we say whether or not income is subject to self-employment taxes. And so we usually argue that your income is not a trade or business because we don't want to pay self-employment taxes on it. But so this is always, it's going to be a fine line to walk in all of these things to say that yes, it's business income, but no, it's not subject to self-employment taxes. So we'll see how that goes. The best guess at this point is that cash rents and typical share rents are going to be out because we're saying that you don't materially participate in those things, therefore it's not a trade or business. The way that the law is currently written, though, a share rent landlord that sells to a co-op would potentially be able to qualify, and we'll talk about this co-op thing in just a second, but the way that that piece of the law was written is it's an or to the business income. So if you have business income or income from the co-op, and so potentially we could get it here with if that part stays, but that is the part that Congress is promising to fix. So we'll see how that goes. There is interest in whether or not this will increase the number of share rents that are out there. If the landlords can qualify for this 20% deduction, it may be more favorable for the landlord to want to do a share rent. Of course, if we're taking a share of that income and moving it over to the landlord's production, that means it's going to reduce how much production that the tenant has. So it could reduce their deduction. So, you know, a little bit of a trade-off there. There is still hope that self-rentals could qualify. Again, we're going to need IRS to tell us whether or not this is, but a self-rental means that and you own a C Corp and you rent the ground to your own C Corp, they call that a self-rental. When it came to the net investment tax, which was part of the Affordable Care Act, they did say that self-rentals were part of your business income and you didn't have to pay that 3.5% or 3.8% on self-rentals. So we've got a little bit to stand on in the fact that IRS has already said that self-rentals is tied to your business. So if that comes to place, that means that C Corp owners could actually qualify for this deduction. And even if you cash rent, okay, because we're going to be saying that that's tied. Again, IRS would love to tie that rental to your business income because they would like to say that that's self-employed income because it's your business income and it's all part of the same pot. And so we have to be careful what we wish for in making sure that we can continue to keep that line between, yes, it's tied to my business, but it's not self-employed, okay, because the 15% deduction is not going to, or the 20% deduction is not going to add up the same that 15.3% tax is going to, in the way things work, because that deduction comes before taxable income. Okay, so again, lots of unknowns in all of that, but let's go through a couple more pieces of this, because like I said, it's not easy. If you're over the $315,000, there is that wage restriction where they're going to limit you to 50% of wages or 25% of wages and a percentage of your investment. But in order to qualify, your wages must be subject to employee withholding. So that means that we're not going to be able to include anything that's an independent contractor. So if you're paying somebody and reporting it on a 1099, not wages. If you're paying somebody with commodity wages, doesn't count. And if you have kids under the age of 18 and you're a sole proprietor and you're paying them and there's no Social Security withholding there, not going to count. Okay, so we need some real wages in order to make that work. This is really the same rules if you're familiar with the domestic production activity deduction wage rules, same rules. They just brought those over. Okay, so I'll go through kind of the simplification of these calculations. So if your income is less than $315,000, your deduction is going to be 20% of your qualified business income plus 20% of your cooperative dividends or your taxable income less net capital gains, which essentially says that they're not going to take away your capital gain income and you can't take your taxable income below zero. Okay, so that's going to be the bigger disqualifier for most people, but it's just going to depend on your mix of income. If your income is more than $315,000, your deduction, like I said, it starts to get complicated. The same 20% of your qualified business income or 20% of your qualified cooperative dividends or 50% of your wages or 25% of your wages that you paid plus 2.5% of the unadjusted basis immediately after acquisition on all qualified, I should say qualified, I missed an F, sorry about that, on all qualified property. Again, a term that we've never had before, so we really need IRS to tell us what that means. What we think it means is that it's going to be the sum of the purchase cost of all the assets that you bought that haven't passed their full life. So that means any tractors and combines that you bought in the last 7 years, any cows that you bought in the last 5 years, those kinds of things. And so we'll have to see. Like, that's a kind of a big one that we're still waiting on. And again, still limited to your taxable income less net capital gains. And don't let that net capital gains things really throw you too much, because if we're taking your taxable income to zero, those net capital gains are likely going to be taxed at 0% anyway, because they're going to be within that lower tax brackets. So it's probably not a really bad thing that they're taking those capital gains out of there. So not too bad. Okay, so let's talk about how this is factored in the co-ops. Okay, so again, I put this as the law was passed, since they have promised to undo this, but nothing's happened yet, so we're sticking with what we got. As the law passed, it says members of co-ops can use 20% of the income from their cooperatives instead of that 20% of qualified business income. Okay, and it specifically says it includes patronage dividends and per unit retains. And per unit retains is nothing that we had seen up until that domestic production activity deduction, and they were using that to report when the co-op was deeming the members' production to be their own. Okay, and in essence, it was your gross income that you sold to the co-op is what they put on that per unit retains line. So what happened here is, instead of getting a 20% of net calculation, if you sell to the co-op, you're getting a 20% of gross as a deduction. And there's a big difference between 20% of net and 20% of gross. And that's what the letters from the co-ops were starting to come out and say, was that, hey, you know what, you can sell to us and it's going to save you, they were saying up to 19 cents a bushel. If you sell to us, we can save you that much in taxes. So we'll walk through a little bit of that discussion here in just a second. The income does need to come from the cooperative. This was a question that came up earlier in the day, and so I want to make sure I hit it. But it doesn't mean you can't deliver the grain to an ethanol plant. Okay, so you can deliver the grain to the ethanol plant as long as the income comes through the co-op. You're going to be fine still. And so, you know, that plays into this a little bit, and it's kind of hard to know exactly what you need to do, but let's look at a couple examples, and that might help. Actually, got an example here. That's a lot of numbers on the page, and I apologize for that. I tried to kind of pick out what I thought was maybe a typical operation that comes through our office. And we've got $1 million of gross income, most of that being from grain sales. Got $900,000 of farm expenses, so we have a net farm income of $100,000. I put $20,000 of non-farm income on there, so their total income was $120,000. Some adjustment to income, which would mostly be self-employment taxes. So all three columns get us to $113,000 of adjusted gross income. Again, remember, that's that bottom number on the front of your 1040. And whether you sell to the co-op, you sell to a private grain company, or there was no 199A, all those are the same. Okay. So if we get the 199A and you sell to a co-op, we get 20% of that gross income limited to taxable income, which is why we have a 199A deduction of $89,000. Because that basically takes your taxable income to zero. If you sell to a private grain company, you get 20% of net farm income. That's 20% of that $100,000. That's less than your taxable income. So we're going to pay about $7,900 in tax, which is, of course, $7,900 more than if you'd sold to the co-op. But the other thing that I want to make sure we point out is the fact that if we didn't have this 199A, even at 20% of net, this is a really good deal, even if we don't get the 20% of gross from the co-ops. So keep that in mind as well. So I put that last column on there, basically how it would have been taxed in 2017. In that year, you would have paid, or this year, you would have paid $15,500 in taxes. So even with just the 199A, the way it was intended to be written, you're going to save $7,600. But if they keep the co-op thing in there, it could be pretty easy that a farm making $100,000 is not going to pay any income taxes. Doesn't mean you're not going to pay self-employment taxes, but the income tax part is going to be gone. I did 2 more examples in there. Actually, on the webinar in your handouts, I've actually written 3 different things about this, but the first one is on this 199A, and I have 3 different examples in there. And they're also available on our website, which I've got here, all 3 of these. And so if you want to jot down that website, we can do that. And I did want to point out that our website is moving host and they're revamping it sometime in the next 6 weeks. So hopefully things don't get too lost, but you also have access to that if you just want to download it from the handouts on here. So, because there's a whole lot that we need to think about if the co-op provision stays. And what I come down to is there's no one right answer. Okay, it's not a matter of everyone should sell 100% of their grain to the co-op in order to take advantage of this. I think the benefits, in a perfect world, and things are just right, I can make that come up with that 20 cents a bushel savings by selling to a co-op. But I also have producers that will get nothing from extra from being able to sell to that co-op. So the biggest difference that it looks like to me it's going to depend is on your profitability level. Okay, so that we talk about that as your net income ratio. How much of your gross income is left as net? So the higher that ratio is, the more advantage you can have by selling to the co-op. If you're grossing $1 million and netting 10,000, we don't need to sell much to the co-op to get 20% of that to be more than $10,000. Okay. If you're grossing $1 million and netting 500,000, then we've got to sell a lot of it in order to get enough to cover that. In fact, we couldn't sell enough. Okay. So again, higher that percentage is, the more this is going to affect you. This also could depend on your non-business income. If you don't have much non-business income, non-farm income, it's not going to be much of a difference. But if you have a lot of non-farm income, we could want a really high deduction to offset some of that non-farm income. We could actually get that. Again, there's so many ways to figure this that it's going to be really individually specific on whether this is going to benefit you and how much.
Tina?
Because if your income, yeah.
We do have a question kind of on this 1090
Okay.
or 199A area.
Okay.
And the question is, what is the likelihood we get to the end of 2018 and the 199A deduction still stands?
I think the 199A as a whole will stand. And again, you remember this, you have to think about this as bigger than farming, because this applies to all business income, no matter what you do, unless you're a service industry, like a tax preparer wouldn't qualify. But that's the only outside. Every other business in the United States is going to get this. So we have to step back a second and remember that this is bigger than farming. But the co-op part of it is very specific to agriculture. And that's the part that really kind of sounds like we're on shaky ground. And maybe, there's other people that would know better as to what's going on in Washington right now, because it's one thing to get some language drafted, and it's a whole nother thing to have the politics work out to get it passed, because we have to have another vote to say, yes, we want this change done. And this isn't the only technical correction that is needed in the bill. It's just the biggest one that affects agriculture. So there should be a technical correction bill coming up sometime. It's just a matter of when people can get along well enough to do it. And it could be something that, the next budget bill, it could be thrown in. It could be thrown in on other kind of small bill that has a good chance of passing. They throw stuff in on all kinds of stuff. So I think 199A as a whole, I think is good. We're going to get 20% of net. Now the co-op thing, again, that's outguessing Congress, and I try not to do that very often because I'm not good at it.
Yeah. We do have another question on the 199A as well. And it says, so if you have non-farm income, but your farm income is zero, can you take advantage of the 199A?
So if your farm income is zero, the way it was intended is no, but if you sold to the co-op, there's a potential that you could. And again, that's another thing that wasn't the way it was intended. It's just what it says, 20% of qualified business income or 25% or 20% of what you sold to the co-op is because of potential that you could. And again, it wasn't what it was intended, but I think you could that way. So it just depends on if this part sticks. Any others?
That's all the questions we have to this point, but it gives me a great opportunity to let others know that maybe it jumped on later when we started. If you do have a question, you can certainly type that into the question box or into the chat box, or you can raise your there's an icon that looks like a hand, and if you click on that, I'll see that you have a question. I'll unmute your microphone so you can ask that question. And also, Tina, you alluded to some handouts, and we do have handouts that are available for you to download as part of this webinar. If you click on the handouts tab in your control panel, you can see those, and you can download those and print those off as well. So.
Yeah, and they'll have a little more detail than what we're going to go through today. So let me go on. Like I said, we talked about that page just a little bit already. So that kind of covers 198.9A as much as we can. Like I said, anytime there's a brand new tax law, this wasn't just a tweak or a correction. This is completely different law written. So it's going to take a little time to figure it out. And that makes it tough in knowing what you should do. But if you've got more questions about whether you should sell the co-op or not, that, like I said, that one handout's like 3 pages. You know, I go through quite a bit of detail in that, and hopefully that'll help answer your questions. So let's move on to the other big thing here, and that is that they have eliminated the 1031 exchanges for anything other than real property. And this is something that a lot of people get confused on because they don't think about 1031 exchanges and tractors. They think about 1031 exchanges and how they apply to land, but anytime you trade a tractor and we're not recognizing the gain on that, you're doing a 1031 exchange. It's just that it doesn't require the same complexity as land because the dealer takes care of all of it for you. Where it happens in one time, you never touch the money, all of those requirements are still there. But anything that you trade after January 1st of 2018 is going to require it to be sold on your tax return. That means and then we get to depreciate the full cost of the new one. So a little record keeping change, make sure that as you're entering that information in your books, you're giving your tax preparer both of those pieces of information. Before, all we cared about was the boot paid, the difference paid. But now we're going to need to see exactly what the purchase price of the new one was and what the trade-in value of the old one was. They did give us a trade-off in doing this of basically saying, well, that's fine, we'll just give you unlimited depreciation then. And that's a pretty good trade-off, but it's got a couple caveats on itself. So let's talk about this. Go through a quick example. I just put a tractor on here with a purchase price of $200,000. The dealer's going to allow you a trade-in of $150,000, so you're going to pay $50,000 in boot. Okay, and on the old rules, we would have said, okay, you've got $50,000 of depreciation. We'll use $179,000, and it's gone, right? So we had a net change to your tax return of $50,000. Now we're going to most likely recognize a $150,000 gain on your tractor. That's assuming it's depreciated out. But with all the depreciation we've had for the last 10 years, most assets are completely depreciated out, which means, so we'll recognize that $150,000 gain. Now we have $200,000 of depreciation to take. So it really changes the tax return exactly the same, okay? And so you might be wondering, why do we care if it doesn't make any difference, right? And because there's some things that do matter. And the caveat to the unlimited depreciation is it's really unlimited for about 5 years, okay? So what they've done is given us $1 million of Section 179, and that's permanent, okay? So there's no sunset on that, nothing. We're gonna have $1 million limit. What was a $500,000 is now $1 million. And then they said, okay, you can have bonus depreciation as well. But that bonus depreciation has that 5-year sunset. Okay, so we'll talk about that again just in a second. Let me keep unpacking some of these things. The gain on those new assets, on the old assets as you're selling that old tractor, it's ordinary income, which means it's not subject to self-employment taxes. So that's pretty good. That's right. That's a lesser tax than if it was on your Schedule F. The depreciation, though, goes to your Schedule F. So it's going to offset both ordinary income and self-employed income. So that in this example, that $150,000 of extra depreciation in the tractor is going to save you, or could save you, $23,000 in self-employment taxes. And so, you know, that's kind of an important thing there. The last thing I have on the page is, so again, a very technical thing in the fact that if the gain in that tractor potentially gives you capital gains, which it could, what it looks like that will eliminate that income from being part of the 199A deduction. But if it's regular income, not capital gains, then we should be able to add that to your farm income and get the 199A. Okay, so lots of stuff going on, and there really are so many moving pieces with this. It's kind of hard to understand how they're all going to work together. But let's talk about the bigger issue. I think from a federal tax standpoint, this is going to either be a no change or a win for farmers. We're either going to pay less tax or it's not going to make any difference. But we have some state level issues to talk about here. And again, these are all unintended consequences of passing these laws that they don't, quite figure out how far it's going to trickle down. But in Nebraska, we're looking at a change in how we're going to report these assets for personal property returns. In the past, well, and it still is, we use federal depreciable property value to put on your personal property return. In the past, that's meant a $50,000 value for most things, because we had an old asset that was depreciated out. So our only basis was the boot paid, and you paid personal property taxes on $50,000. Now we're going to pay personal property taxes on $200,000. Okay, so this is something that will probably hit. We're going to file that first return with higher taxes in 2019. So that'll actually probably be the 2020 year that you start to see that increase, but something that you should probably think about. But for most producers, the federal tax savings should more than pay for any increased property taxes that you're going to pay, especially if you're filing as a Schedule F. Okay. Iowa actually has a little bit, and other states, there's several states that have a bigger issue with this than what we have. We are lucky in the fact that Nebraska follows federal AGI and with no adjustment for depreciation. In Iowa, they're only allowed to take $25,000 of enhanced depreciation. So that means if they needed to take that $200,000 of depreciation to get their federal to work out, they're going to have a $175,000 add back on Iowa that they're going to have to pay state income taxes on. And so for those states that have not followed federal and depreciation rules, those producers could be looking at a significant increase to their state tax liability. Okay, so I ran through another example. Again, it's the same farm that we did the 199A on, just with the old trade rules and the new trade rules. So I highlighted in red what would change. And with the new trade rules, we're increasing that depreciation like I talked about there, and we're increasing a gain on the tractor. Again, if we get down to that total income, it's exactly the same. Down to adjusted gross, exactly the same. All right, but what's going to be different, that Section 199A could potentially be zero with these new tax rules. So again, we spent all that time talking about whether or not you need to sell to a co-op, and the new trade rules could throw out whether you qualify for a 20% deduction. Again, it's just going to wait until we find out what qualified business income exactly is, and whether or not the sale of that tractor will qualify. Because let me pop back here, because that extra depreciation actually took your net farm income to negative 50,000. I didn't highlight that one in red, and I should have, because it actually wiped out your Schedule F income, and that's why you no longer qualify for a 199A. So taxable income is going to be different. With the old trade rules, it would have been a little bit lower just because of that 199A. But look at that self-employment tax line. Because we wiped Schedule F out, we're going to save $14,000 in tax there. So even though we'll pay a little bit more in income tax, if we do lose the 199A, we're still going to save $6,500 by not paying any self-employment taxes. If we get that tractor income as qualified business income, then you're probably going to be saving the additional $6,500 of self-employment taxes, or really it's going to save you that $14,000 of self-employment taxes, because income wouldn't be any different. So again, this alone is a pretty good deal, and this is going to affect partnerships and Schedule Fs, because we're talking about self-employment taxes. If you're an S Corp and a C Corp, you don't pay those, so you're not going to save them. Okay. All right, so talk about depreciation just a minute here. I did say that Section 179 limit was raised to $1 million. They put the phase out limit at 2.5 and index that for inflation. That means if you purchase more than $2.5 million worth of assets, they start to take that Section 179 away. Remember, that's going to be purchase price, not trade-in value anymore. So that will be a little bit easier to hit that number. They brought bonus depreciation back to 100% and dated that back to September of 17. Very little of this tax law affects 17, but this one does. In 17, you can choose 50 or 100, because we had 50. And so we have a couple of producers who had planned on 50% bonus, and 100 was going to kind of mess them up. So they did give us the choice there. We have that through 2022, and you can see that it scales down again through 2026. So that completely unlimited depreciation, like I said, is good, but it's just through 2022. The other change that they made with bonus is it used to only be brand new property, and now they've made it new or used. So you can go either way with that. So it really is completely unlimited depreciation for the next 5 years. Another interesting change that they made is they made farm equipment that is brand new a 5-year recovery life instead of 7 years, with the exception of grain bins, fences, and other land improvements. Okay, so probably not a huge deal, especially where we have unlimited ability to write everything off. But if you do have new property, we're going to have a new life class for that. The other change they made is that we don't have to use 150% declining balance anymore. That's probably nothing you've ever heard. But our regular depreciation schedule will be a little faster. Farmers used to have to use 150%. So little changes, but probably don't mean a lot. Couple other things that I just want to go through. They did do some changes to business entertainment expenses. So anything that you were paying for entertainment and deducting are no longer deductible. That includes membership dues. That would be like at the gym or something like that. You can't deduct those kinds of things. No employer deduction for business-related entertainment. Any meals and beverages that you pay for the employer's convenience are now limited to 50%. So that's the biggest thing as for what we're talking about for C Corp owners, where a lot of times if we've taken employee housing, we've said that they have to be on site, need to eat there, deducted those meals, those are going to be limited to 50%. And then after 2026, you can't take it at all anymore. Sounds again like a bad deal, but again, it was a pretty fair trade in the fact that they wanted to eliminate all housing. So losing meals was a little bit of a trade-off there. Employee awards of cash gift cards are no longer deductible. They've said that they specifically said that if you give them those, we have to add them as taxable wages and cannot take them as just as a business deduction. All right, and the qualified transfer. Okay.
We do have another question real quick here.
Okay.
It's basically on do we want to pay some self-employment taxes so we can qualify for disability, death benefits, as well as Social Security and retirement?
Yeah, for sure. And we talk about saving self-employment taxes, but we don't want to pay none. And so that is an important thing to point out. And there is an optional method of self-employment taxes that we can use to get you 4 quarters of coverage, so you're covered for disability and survivor benefits. So if your income is to the point where we have to take enough depreciation to take that Schedule F0, then we want to talk about that. But it's gonna take planning in a whole nother way. It's really gonna affect how we do things, because we really don't want Schedule F to be negative. We're losing a lot of things if we do that. So depending on how much you're trading, though, we might have no other choice, and we'll have to use that optional method. But that was a definite good question.
Okay. Have another, Doug Duba has a question. It's the 50% calculation seems to disagree with what I was told the other day. So.
Yep. I did some more looking, and we do have that limit in place. It was definitely part of the bill that we're going to have to adhere to. So. But it's just the meals and benefit or beverages that are going to be limited. Any other housing that you're taking, we can still have at 100%. Okay.
Okay, that's the questions I have for now. So. Okay.
Yep, that one hasn't gotten a lot of publicity with everything else going on. So the other question that we've been getting a lot is what entities should have, and I still don't think that there's anything in these tax laws that says that you definitely have to be one entity or another. And it's also going to take a little bit to figure out what's all going on with 199A. So I don't think anybody needs to be making major switches. The other thing that's important to remember is that 199A is temporary. It's set to sunset in 2026 as well. So where the 21% flat tax in the corporation is permanent, the 20% net business income is only a few years. So jumping out of a C Corp in order to take advantage of that may not make sense, because we probably can't get back into those other ones very easily. There's definite consequences to jumping back and forth. I put a little here on what the individual income tax brackets are. There's not a whole lot of change. They did drop the percentages a little bit, bigger changes in those higher brackets. But that information's there. The standard deduction has been doubled. That again sunsets in 2025. Essentially, we have 24,000 now for married filing joint. And really what they were trying to do here is reduce the number of taxpayers who needed to itemize. And that as a simplification, and they've probably accomplished that. They also eliminated personal exemptions, and a lot of these are talked about together because they've always worked together. That was, should have said was $40,000 or $4,050 instead of were. So this whole change of whether or not it's good or bad depends a little bit. I just ran 2 examples of just a married couple with no kids. They're going to be better off with the higher standard deduction and no personal exemptions. I've got 4 kids, so I ran that one as an option. And in the past, because I had so many personal exemptions, we're actually going to take a hit in getting to that lower standard deduction. So really just kind of depends. We talked about this as they were writing the bill. So they said, okay, well, we got to do something to help out those families with kids. So they doubled the child tax credit. It was $1,000 per kid under the age of 17. Now it's $2,000, and this is a credit, so it comes off the tax that you pay. They also gave us, for a short time, $500 in non-refundable credit for other qualifying dependents. That means if you have a grandparent living with you, a child over the age of 17, get an extra $500 for them. The biggest deal here, though, was they increased the phase-out limit. If you hit 110,000 income married filing joint, they started taking away your child tax credits. Now that income is 400,000. So this kind of blew open the number of people that will qualify for the child tax credit. So if we go back and say better or worse with a child tax credit, in our case, we're going to end up now being better off with that child tax credit, assuming that it was 25% tax bracket. So the personal exemption loss is going to cost us $3,000, but we're going to get about that back in child tax credit. So maybe end up being a kind of a net. Again, depending on where AGI is, could have been above or below that and still been in the 25% tax bracket. Not going to affect a lot of people, but if it does affect you, you want to pay attention to the Kiddie Tax, and that is a tax if you're under the age, you have a child under the age of 19 or a full-time student and they have unearned income. Then in the past, if their income was high enough, they would tax that at their parents' rate so that there wasn't an advantage for pushing it in the kids' names. They've actually made it a penalty now, and they said any of that's going to be taxed at the trust rates, which basically means if they've got over $12,000 of income, they're going to be paying 37% tax on that. So that could apply if your kids are owning shares of a family partnership or an LLC, or if you're gifting them grain. Some of those kinds of things could potentially push them into that 37% bracket pretty fast. So again, if you're in that kind of situation, you want to make sure that you don't do anything this year to cause that to trip. There was really no change to the capital gains rates. That's another thing that's been asked a lot. That it is decoupled from the new brackets, which means it used to go to the top of the 15% bracket, and the 20% bracket kicked in at the 39.6% rate. And there's actually a potential that, again, this is another one of those technical things that was probably unintended consequence, but the way the law for capital gains is written is it says the 20% bracket starts when the 39.6% bracket starts, and we no longer have a 39.6% bracket. So that kind of means we no longer have a 20% capital gains. Again, not as it was intended, so we'll see how they fix that, or if they do, because otherwise we'd have a max capital gains of 15% no matter what your income was. We talked a little bit about that state and local taxes limited to 10,000, so I won't talk about that long. They changed a little bit on medical expenses, but only for 2 years, so not a big deal. The charitable deductions, they allowed up to 60% of your AGI. It was 50. I think I've only had one person who's hit that, where they've donated more than 50% of their adjusted gross income in 1 year. So it doesn't happen very often that we actually worry about that, but a little bit better on charitable donations. They did limit mortgage interest for mortgages with less than, that should be 750,000. I'm sorry, I missed a zero there. Still allowed on your second or first home. Home equity loans are no longer deductible. All those that you had in place, I think, are going to be grandfathered in, but it would be any new loans that would qualify there. There was also a limitation on itemized deductions. If your income was high and your itemized deductions got big enough, they would take some of them away. That's gone now, so you can take all of your itemized deductions again. They did, excuse me, eliminate anything towards the bottom of Schedule A for itemized deductions. They took quite a few of them away. So that would be employee business expenses, tax prep fees, investment interest expense, personal casualty and theft losses, with the exception of federally declared disaster areas. So, you know, if your house gets destroyed by a tornado and it's not in a federally declared disaster area, we have no ability to write off any of those losses now. So again, not something that gets used very often, but could be significant if that was the case. Final thing I have is for NOLs, there's a 2-year carryback for farm losses and no carryback for anybody else. So we used to have a 2, 3, or 5-year carryback for NOLs. Now they originally said no carrybacks, and they gave farmers an ability to carry back for 2 years, but we can carry those forward. Again, if we can avoid NOLs, that's what we want to do in general, but for the most part, we're going to have to carry those forward now. Again, that's that website where if you go to our website, and then we have a tab that's called Farm Library, and those 3 articles that are also available in the handouts are available there, that you can get those. And just the 3 of the first one is just a real general update, and then the other 2 are a little bit more detailed in those 2 major things that seem to be impacting farms the most. And that's always a place where if I put something new, that's where you can go to check that. And as we go and continue to learn more, that'll be where I put more information. So also put phone number and email address there if you've got questions. Certainly a busy time, so finding me in the office is sometimes a tricky thing, but if we can help, we're happy to do what we can. Otherwise, if there's more questions, Jay, I snuck it in right at an hour with no questions. So.
Hey, that's good. So, yeah, we don't have any questions up, but certainly we have people on the line that if you have questions, now is your opportunity to get those asked. Either click on the little hand icon, I'll unmute your microphone where you can ask it, or you can type in your question into the question box and we can get that asked as well.
Should say I'll answer questions, but as long as I don't know is an acceptable answer, because there's an awful lot of questions out there that nobody seems to have the right answer to.
Yeah. It did have a lot of good positive comments. We had a few people that had to drop off the line just because they wanted to watch the State of the Union address. So
I had some big competition today. So.
You did, but we do have a couple questions here. One is, how is all cash rent handled?
So I'm assuming from a federal tax standpoint, you know, cash rent, when you're receiving it, is rental income, so it's not subject to self-employment taxes. It's just taxed as ordinary income. I guess if you're asking about how cash rent's handled, if you paid it, you know, it goes on Schedule F, so it's a deduction that offsets both self-employed and ordinary income. How it's going to be handled with 199A is we're just going to have to wait on IRS to tell us on that one, because it's a little too broadly written or vaguely written to be able to pinpoint that for sure.
Okay. Another question here is, are donations of grain changed with the new law?
They haven't changed, but there probably is more reason to give grain than ever before. So you can still, for those of you that maybe aren't aware, you can give grain to a charity. There's some rules that you need to apply, and I'm actually, it's probably the next article that I'm going to write when I find some time to brush up on those rules and make sure we handle that correctly. But with less people itemizing, giving grain is going to be a good alternative. It's always been a good alternative because you can reduce self-employment taxes if you're Schedule F or a partnership by not recognizing that income on Schedule F. But no, you can still gift grain, and I think probably more people will do that than they have in the past.
Okay. We do have Mark has his hand up, but I'm not able to unmute your line, Mark, because you didn't enter a PIN in, so I don't have control over unmuting your microphone. So if you want to type your question in, you could certainly do that as well. And if anybody else has questions, please feel free to ask those questions by either typing them in the question box or raising your hand. Well, I'm not seeing any other questions. I know Jay Rimpey is also on the line. Jay, do you have any other thoughts or questions while we're...
No, can you hear me, Jay?
Yep, coming through loud and clear.
Okay, I did get a question through text. I'm guessing it was probably meant for you and they sent it to me by mistake, but okay. It says, how do you determine the purchase price and trade-in price on the equipment trades?
Yeah, so we're going to need to see the trade documentation from the dealer now, and what they list as the purchase price of that new one and what they list as trade value are the numbers I think we're going to have to use.
Okay.
I think the biggest thing from there is from a record keeping thought is make sure you hang on to that stuff, keep it in a place where you can get it to your tax preparer, because we're going to need to see those more than we ever have.
Oh, I have another question here.
Okay.
All my income is cash rent and I'm retired. How is that different from 2017 to 2018?
Probably not going to be significantly different, other than those individual tax brackets are going to be a little bit lower. So, instead of paying 22 or 25%, you might pay 22%, or instead of 15, you pay 12%. That's going to be the biggest difference for you. And then depending on whether or not you itemized or not, that could potentially be a difference for you. And whether those itemized deductions were coming as state income taxes and real estate taxes, or if you were less than 24,000. So that's probably going to be the bigger question, but won't be significantly different, just a little bit less probably.
Just going to say while we're waiting, if there's any more last questions, I'll filibuster for just a second, and I hope everyone enjoyed this evening's webinar, and I want to publicly thank Tina for her taking her time out of her busy schedule to help us out with this. And I'm sure Tina would be happy to answer anybody's questions in the future, or you can send them to us as well, and we'll try to find the answers too. And I'm guessing, Tina, as we get some of these IRS rules and regs over the next few months, we might want to have another one of these to clarify some of these things.
Yeah, I think it's good. Yeah, there's going to be plenty to talk about this year as we get into this and see how quickly IRS gets us some information. It's no secret IRS is understaffed. So it'll be interesting to see how they handle this, all this extra work that we've kind of gotten thrown on them, and how long it's going to take to get this stuff through. And I hope they push it through as quickly as possible, because it does have some significant impacts on how everybody does things. So, but they don't ask me how quickly they should work. So.
Yep, we do have another question here, and
okay.
Are there any changes to education credits?
No, the education credits got left untouched. So there was some talk about simplifying that and coming down to 1 instead of 3, but nothing changed there.
Okay. Okay, well, I'm not seeing any further questions, so I think Jay did it well, but Tina, thank you for your time very much. We had a good group on the line tonight, and again, we did record everything, so you feel free to come back and watch it later and shoot any questions to us or to Tina. You have her information is on the screen right now, so write that down quick before we end this webinar. And we will see everybody next time that we do this.
Okay.